Welcome to the Property Wealth Podcast. We're so glad you could join us today. If you've ever thought about investing in real estate but felt hesitant due to the risks, you're in the right place.
Absolutely, Sarah. Today we're diving into something really interesting: equity sharing agreements. It's a way to partner up and invest without taking on all the risk yourself.
Exactly. And for many people over 40, this could be a game changer. We'll explore how these agreements work, the potential benefits, and some real-life examples that can help you envision this strategy in action.
Right, and we'll also talk about some common pitfalls to watch out for, so listeners can navigate this landscape with confidence.
Yeah, we want to make sure you have all the practical advice you need to make informed decisions. By the end of this episode, you should feel empowered to consider equity sharing as a viable option for building your wealth.
Exactly. It's all about creating opportunities that fit your situation, rather than feeling overwhelmed by the traditional routes.
So let's get started. Mike, can you break down what exactly an equity sharing agreement is and how it typically works?
You know, Sarah, when we think about equity sharing agreements, it really resonates with people over 40 right now, especially with everything going on in the economy.
Absolutely, Mike. We're seeing inflation rates that are making it tough for a lot of folks to save for retirement, and this can feel overwhelming.
Right, and a lot of people in that age group are starting to think about their retirement timelines. They want to ensure their financial security, and traditional paths are becoming, well, a bit rocky.
Exactly. The stock market has its ups and downs, and for someone who's nearing retirement age, that unpredictability can be stressful.
So equity sharing becomes a viable option. Right? It allows you to partner with someone, share the risk, and potentially gain access to properties that might otherwise be out of reach.
Yeah, and I think a lot of folks don't realize that it's not just about splitting costs, it's about leveraging each other's strengths, too. I remember a listener once shared how he partnered with his adult daughter to buy a duplex.
Oh, that's a great example. They could live in one unit while renting out the other, creating a stream of income. And let's not forget, it helps with the rising costs of living.
Right, and it also fosters that sense of community and support between family members. Many people are starting to look at wealth transfer strategies.
Exactly. Instead of simply leaving an inheritance, why not build wealth together? It creates shared experiences and gives the younger generation a foot in the door of the real estate market, which can be really tough these days.
Yeah, and with rising interest rates, homeownership feels less attainable for many, so partnering up can really alleviate that pressure.
And it's not just about the financial side of things, Sarah. There's an emotional aspect too. Knowing that you have a safety net, that you're not entirely alone in this investment journey, can be such a relief.
Definitely. The peace of mind that comes with shared responsibility, it's priceless. I think it's important for people to realize that they don't have to take on the entire burden themselves.
That's so true. And I've seen this in action with a couple who were both in their late 50s. They wanted to downsize, but also wanted to invest in a property that could generate income.
Oh, I love this. So what did they do?
They teamed up with their friends, who were also looking to invest. They found a triplex, and they each took a unit. They're all sharing the mortgage and expenses, and it's really worked out for them.
That's amazing. They get to enjoy their retirement years, but also have a steady income flow. Plus, they've built a closer friendship through it all.
Right, and it's not just about financial benefits. It's about building those connections and relationships. And let's face it, with the current economic trends, more people are looking for ways to diversify their income.
For sure. And the real estate market is shifting too. Some areas are booming while others may be slowing down. Equity sharing can help mitigate some of those risks.
And speaking of risks, many people over 40 might be hesitant due to fears of market downturns. But with equity sharing, you're not fully exposed. You're partnering with someone, which spreads that risk out.
That's a great point. And it's also about being proactive. If you're feeling uncertain about retirement, why not take steps now to secure your future?
Exactly. Think of it as having a backup plan. If one area of your investment isn't performing as well, you've got other partners and properties to fall back on.
Plus, there's something empowering about taking control of your financial future, especially as you approach retirement. It's about being strategic and making informed decisions.
Right, and I've seen it work for so many people. One investor I know She was in her early 60s, and she used an equity sharing agreement to buy a vacation rental with her sister.
Oh, that sounds fun.
Yeah, they're able to enjoy it together, but they also rent it out during peak seasons. It's been a fantastic source of income for both of them.
And they get the added bonus of family bonding time. That's what it's all about, enjoying life while building wealth.
Exactly. And that's the beauty of equity sharing. It blends the emotional and financial aspects of investing. You're not just making money. You're creating memories and experiences.
So for those listening, it's important to recognize that now is the time to think creatively about investing.
Absolutely. As we transition into core strategies, let's explore how to structure these agreements effectively and make sure everyone involved feels secure and supported. So let's dive into equity sharing agreements then. They can be a really smart way to partner with someone without taking on all the risk yourself.
Right. So how does that work in practical terms?
Well, the basic idea is that you find a partner, maybe a friend or a family member, who's willing to invest alongside you. You both contribute to the down payment and the mortgage payments, and then you split the profits when you sell or rent out the property.
Got it. And what kind of financial structure do you usually see in these agreements?
Typically, you'd want to outline everything in a legal document. This would include how much each person is putting in, how profits are split, and what happens if one person wants to sell their share.
That makes sense. So what's a good rule of thumb when calculating potential profits?
A solid rule of thumb is the 1% rule. It suggests that the monthly rental income should be at least 1% of the purchase price of the property. So if you buy a property for $200,000, you'd want to aim for at least $2,000 in monthly rent.
That's a really straightforward metric. But what if the property doesn't meet that 1% rule?
Well, it doesn't mean you should automatically walk away, but it's a red flag. You'd want to look deeper into the property's cash flow and potential appreciation.
Right, and I assume you'd also want to consider expenses, like property management, taxes, and maintenance costs?
Exactly. That's where the 50% rule comes into play. It suggests that you should estimate your operating expenses to be about 50% of your gross rental income. So if you're expecting $2,000 a month in rent, you'd budget around $1,000 for expenses.
That's super helpful. So if you net $1,000 a month after expenses, that's $12,000 a year.
Exactly. And if you bought the property for $200,000, you're looking at a cap rate of around 6%.
Can you break down what cap rate means for our listeners?
Sure. The capitalization rate, or cap rate, is essentially the ratio of your net operating income to your property's purchase price. It helps you evaluate the potential return on an investment. A higher cap rate generally indicates a better return, but it could also mean more risk.
So if you're looking at a property with a cap rate of, say, 10%, that might be attractive, but it could also come with higher risks, right?
Right. You just want to do your homework on why the cap rate is high. It could be in a less desirable area, or maybe the property needs significant repairs.
Makes sense. And aside from the numbers, what other factors should someone consider when entering into an equity sharing agreement?
Good question. You definitely want to discuss the long-term goals with your partner. Are you both looking for quick cash flow, or are you in it for the long haul?
So aligning your expectations is key.
Absolutely. You also want to think about the type of property you're investing in. Single-family homes tend to attract long-term tenants, while multifamily units might provide more cash flow but could require more management.
And what about financing options?
So traditional mortgages are an option, but you could also look into FHA loans if you're a first-time buyer. They can allow for lower down payments, which might be appealing for an equity share partner.
That's a great point. And what about properties that are in need of renovation? How does that fit into the equity sharing model?
A fixer-upper can be a fantastic opportunity, but it's crucial to factor in renovation costs up front. You might want to use the 70% rule here. Buy a property for no more than 70% of the after-repair value, minus the repair costs.
So, if a property could be worth $300,000 after repairs, and you estimate $50,000 in renovations, you'd want to buy it for no more than $210,000?
Exactly. That way, you're ensuring there's room for profit once the property is rehabbed and sold or rented out.
Love that strategy. It really helps keep the investment sound.
And don't forget about a deal evaluation checklist. It's a practical tool to ensure you're covering all your bases. You should check the location, rental market trends, property condition, and potential for appreciation.
So you're essentially creating a roadmap for your investment.
Right, and it helps keep emotions out of the decision-making process. You want to base your choices on data rather than feelings.
That's so important. So what are some common pitfalls people face when entering into these agreements?
One major pitfall is not having a clear exit strategy. You need to discuss what happens if one partner wants out before the property is sold.
That could lead to some serious disagreements.
Exactly, and another risk is underestimating the costs involved. People often overlook maintenance and unforeseen repairs.
That's definitely something to keep in mind.
Also, make sure you're both on the same page about the property's management. If one person wants to manage it hands-on, and the other prefers a property manager, it could create friction down the road.
Wow, there's a lot to think about.
Definitely. But remember, it's all about communication and setting clear expectations from the start.
That's such a valuable insight.
You know, Sarah, when it comes to equity sharing agreements, one of the biggest pitfalls I see is over-leveraging.
Right. That's when investors take on too much debt, thinking that the property will just keep appreciating.
Exactly. I had a client once who was really excited about this hot market. He bought 2 properties in quick succession, but he didn't fully calculate his debt-to-income ratio.
Ooh, that sounds risky. What happened?
Well, the market took a dip just a few months later, and suddenly he was underwater on both properties. The cash flow wasn't there, and he was stuck with high mortgage payments.
That's a tough lesson. So it's really important to be realistic about what you can afford, huh?
Absolutely. You need to look at your overall financial picture, not just the potential for appreciation or rental income.
I get that. And speaking of cash flow, another common mistake is ignoring it entirely.
Right. Some investors get so caught up in the excitement of buying a property that they forget to run the numbers on what it'll actually bring in.
I know someone who bought a fixer-upper, thinking they could rent it out for top dollar after renovations. But the renovations ended up costing way more than they anticipated.
Yes! And then they were left with a property that was draining their finances instead of boosting them.
So the lesson here is to always do your due diligence before making a purchase.
Exactly. Look at the local rental market. Factor in all the costs. Maintenance, property management, utilities, everything.
And what about tenants? I've heard stories about bad tenants becoming a nightmare for landlords.
Oh, absolutely. A bad tenant can really throw a wrench in your plans. I had a colleague who didn't do thorough background checks on his tenants.
Yikes! What happened to him?
Well, he ended up with tenants who weren't paying rent on time, and he had to go through the lengthy eviction process. He lost months of income and had to spend even more on legal fees.
That's something to definitely watch out for. What would you say are some red flags when screening tenants?
Good question. Look for shaky rental history, inconsistent income, or even poor communication during the application process.
Yeah, if they're not responsive when applying, they probably won't be responsive when they're tenants either.
Exactly. And another pitfall I see a lot is investors trying to time the market.
Oh, that's a classic mistake.
Right? I had someone who kept waiting for the perfect moment to invest, but by the time they finally pulled the trigger, prices had skyrocketed.
So they missed out on a lot of potential gains.
Yep. The market is always fluctuating, and trying to predict those ups and downs can lead to missed opportunities.
So what's the better approach?
Focus on your long-term strategy. Invest when it makes sense for you, not when you think the market is at its lowest.
That's solid advice. And what about hidden costs? I imagine those can sneak up on you.
Oh, for sure. Many new investors underestimate things like property taxes, insurance, or even homeowner association fees.
Right. I've seen people get blindsided by those costs after closing.
Exactly. I had a client who thought they were getting a steal on a property, but the taxes were way higher than they anticipated, which ate into their cash flow.
It's always good to have a buffer, huh?
Absolutely. You should factor in at least a few months' worth of expenses in case things don't go as planned.
So keeping a reserve fund is definitely a smart move.
Yes, and it can save you a lot of stress down the line.
I've also heard that it's important to have a solid team around you, like contractors, real estate agents, and property managers.
Oh, for sure. A good team can help you avoid a lot of these pitfalls. I've seen investors struggle because they didn't have reliable contractors or property managers.
That can really make a difference in how smoothly the process goes.
Absolutely. Working with professionals who know the local market and can provide good advice is invaluable.
So what are some steps investors can take to recover from these common mistakes or avoid them in the first place?
Well, for starters, education is key. Attend workshops, read books, or even find a mentor.
Yeah, that really helps build confidence, doesn't it?
It does. And also, don't be afraid to ask for help when you need it.
Like reaching out to a real estate advisor or someone experienced in equity sharing agreements.
Exactly. They can help you navigate the complexities and avoid those common pitfalls.
And making a solid plan beforehand can really set you up for success.
Yes, having a clear investment strategy and sticking to it, even when emotions run high, can really make a huge difference.
It sounds like the key is to stay informed and be proactive rather than reactive.
That's the spirit. Being proactive can help you spot red flags early and make adjustments before they become major issues.
Well, it's all about building that long-term wealth while minimizing risks.
Absolutely, and with the right mindset and preparation, you can do just that.
So let's talk about what comes next for our listeners who are eager to get started or improve their investing game.
Sure. First, take a moment to evaluate your current financial situation and set clear investment goals.
And then maybe look into local real estate market trends?
Yes, staying informed about market conditions will help you make better decisions moving forward.
Sounds like a solid plan.
So, when it comes to equity sharing agreements, the first step is really understanding your own financial situation. I mean, have you sat down and looked at your equity?
Right, like just assessing your current assets and liabilities can give you a clearer picture of what you have to work with.
Exactly. And if you haven't already, consider using tools like Zillow or your local MLS to get a sense of property values in your area. Just, start exploring what's out there.
Yeah, and don't forget about apps like BiggerPockets, which have calculators that can help you run the numbers on potential deals. They also have forums where you can ask questions and get advice from experienced investors.
That's a great point. And if you're really serious about this, I recommend checking out DealCheck too. It's super user-friendly for analyzing deals, and you can even keep track of your properties there.
Oh, definitely. And when you're looking at potential properties, tools like Rentometer can be really helpful for figuring out rental prices in the area. Understanding the rental market is crucial, especially if you're planning to rent out your share of the property.
Yeah, and speaking of market understanding, one habit I'd suggest is to analyze at least one deal each week. Just pick a property, run the numbers, and see if it makes sense to you.
That's a manageable goal. It also helps build your confidence over time. And if you can, try to attend local real estate meetups. Connecting with other investors can provide you with insights and maybe even potential partners for equity sharing agreements.
Absolutely. Networking can open doors you didn't even know existed. And if you find a local meetup, don't hesitate to ask questions.
And for those who prefer learning from books or podcasts, there are some great resources out there. I mean, the book on rental property investing by Brandon Turner is a solid read.
Yes, and Real Estate Investing for Dummies is another good one. It covers a lot of ground and presents the information in a way that's easy to digest.
And for podcasts, I'd recommend BiggerPockets podcast. It's got tons of interviews with real investors sharing their experiences, which is super relatable and motivating.
Right, and don't forget about creating a financial plan for your investment journey. This doesn't have to be complicated. Just jot down your goals, how much you can invest, and what kind of properties interest you.
Yeah, and it's okay to start small. Maybe even consider investing in a smaller property or a joint venture to spread risk.
That's a smart approach. And you can also keep track of your progress. Journaling your experiences can help you reflect on what's working and what's not.
Definitely. And remember, it's all about taking those small, consistent steps. You don't have to rush into anything.
Exactly. Just focus on learning and adapting as you go. Each little step you take builds your confidence and knowledge.
And as you get more comfortable, you can start to look into more complex investment strategies. There's always room to grow and expand your portfolio.
For sure. Just, keep your eyes on the long-term goal of building wealth and financial security.
Yeah, and don't be afraid to reach out for help or partnerships when you need them. That's what equity sharing is all about, right?
Exactly. It's about finding the right people to share the journey with. So those are some practical first steps. Now let's bring this all together. Well, Sarah, as we wrap up this episode on equity sharing agreements, I think it's been really enlightening, right?
Absolutely, Mike. It's such a practical way to partner up without taking on all the risk.
Yeah, and one of the key takeaways has to be how these agreements allow you to enter into real estate investing even if you don't have the full down payment.
Right. And they really open up opportunities for those who might feel a bit hesitant about diving in alone. It's all about collaboration.
Exactly. And let's not forget about the flexibility they offer. You can structure these agreements in a way that works for both parties. It's about finding that win-win situation.
And the potential to share both the profits and the responsibilities. That's a big one. It really takes the pressure off individual investors.
Definitely. And if anyone's feeling that real estate is out of reach, equity sharing could be the bridge they need to start building their wealth.
So true. It's about making those first steps, you know? Building wealth through real estate doesn't have to be overwhelming.
Absolutely. And speaking of steps, we'd love for our listeners to engage with us. If you enjoyed this episode or found a takeaway that really resonated, please like, subscribe, and drop a comment.
Yeah, we want to hear your biggest takeaway or any questions you might have, and share this with someone over 40 who's looking to invest in property.
For sure. It's all about sharing knowledge and supporting each other on this journey.
And next time, we'll dive into using home equity lines for down payments. Another exciting topic that can really help boost your investing strategy.
Can't wait for that discussion.
Neither can I. Thanks for joining us today. We appreciate you taking the time to listen.
Until next time, happy investing.
Bye for now.